And joining us now to talk more about the U.S. economy and her outlook for growth is Lindsey Piegza. She's chief economist at Stern AG. Lindsey, welcome. Good to have you with us. You heard Steve's report there. How strong was this economic report really? He suggests that once you scratch the surface a little bit, it was a little less than meets the eye.
Well, that's right. On the surface, the headline growth was quite impressive at 2.8%. This was the second consecutive quarter of above 2% growth. But when we look in the details, it paints a very different picture of the economy, especially when we look at the consumer, the key variable in the economy. Now, the consumer was already pulling back in the second quarter, falling down to 1.8% from 2.1%. But the consumer pulled back even further in the third quarter, falling to just 1.5%. Now, when we look at businesses, too, they're very much sidelined, hesitant to invest in equipment, structures, and employees. So this is one of those reports where certainly the devil was in the details.
So, Lindsey, did the market get it wrong then? The market sold off on the idea that the report was strong enough to perhaps change the Fed's bond buying program. It sounds like you would disagree with that.
Well, I think the market was a little jittered by the juxtaposition of headline strength and component weakness. So there's a fear that the Fed will look at that headline number and say, you know what, the economy is actually improving enough that we can begin to roll back accommodation. I do not believe that this is enough to suggest that the Fed will move away from their accommodative path. The Fed has very much focused on the labor market data rather than one quarter's growth data point. And so I think the market will eventually slough this off and realize that the Fed and their accommodative policies are here to stay for quite some time.
And labor market data, you just mentioned it, leads us to tomorrow and the jobs report. A lot of people thinking that jobs report is going to be soggier than some of the more recent ones. What is your prediction here on the high end and the low end?
You know, I'm looking for about 135, 140 in terms of headline non-farm payroll growth. Remember that jobs have been job creation, I should say, has been slowing since the start of the year. At the beginning of the year, we were seeing plus 200,000 numbers. Now we've slowed to a pace of about 140,000, and I suspect that pace will continue to lose momentum as we go to the end of the year, maybe even slowing to a pace of 125,000. So clearly at this point, the current level of production is meeting the current level of demand. And with productivity outpacing growth, there's really no incentive for businesses to hire at this point, especially against the backdrop of added uncertainty given the shenanigans in Washington.
Yeah, that doesn't sound good going forward, though, then, Lindsey. I mean, it sounds as though, even though the headline today looked like the economy was doing better and the recovery was on firmer footing, if you look underneath that and with what you just mentioned about job creation, it sounds like maybe this recovery is just lukewarm.
I think you're very much right. I think we're going to see this 2.5% range for quite some time, even carrying over through 2014. Now, one of the variables, too, that affected third quarter growth was inventories. If we strip out inventories from growth, we saw just 2.1%, or a tenth higher than what we saw at the end of the second quarter. So very much unchanged. And unchanged is not enough strength to suggest that the Fed is ready to roll back those monthly bond purchases.
All right, Lindsey, thank you very much. Lindsey Piegza, chief economist at Stern AG.